record to this. All right, perfect. That work?
Yes.
Okay, awesome. Thanks, Catherine. So a little bit about Tennessee Women in Green. It is a sustainability organization that spans across Nashville that empowers, inspires, and connects women who are committed to environmental sustainability. So TWIG does have monthly programs that are once every month, and the goal is to really bring in a speaker from a different industry that can talk about their career and how they apply sustainability to it. So in addition to that, it is really a network of over 250 plus women, 250 plus women around Tennessee that get to connect through those monthly programs, but also really fun events and educational events like the one we have today. So we're really thankful for both Mimi, Ellen, and Laura for being here today. So a little bit about a little celebration after this presentation. Tomorrow, we're actually going to be hosting a TWIG mixer at Neal. And that's going to be at 5:30 p.m. And the goal is to really celebrate that climate summit and also women who are empowered in sustainability. So there will be a heated patio, light hors d'oeuvres, and then of course, cash bar. So come out to Neal tomorrow at 5:30, and I will drop some additional details in the chat in just a little bit. So without further ado, I'm going to turn it over to Ellen.
All right. Well, thank you, Kristen, and welcome to everybody. So as Kristen mentioned, as I know you all saw from the invitation, this is a conversation about sustainable investing. And we're going to talk a lot more about what that means at a high level, and then also get into some details about what that can mean for you specifically. But in general, when I think about sustainable investing, it's how can you get the best returns for yourself and your own financial goals while also supporting the other causes that are important to you. And the demand for sustainable investing has really grown. Just thinking about everything that happened in 2020, and then a lot of the social movements that we've seen the last few years, Black Lives Matter, Me Too, a lot of things around climate change. All these things have really caused people to kind of stop and think, what can I do to make a difference in the areas that are important to me? And so that is what we are going to talk about today. We'll start with just some brief intros for the three of us from UBS that are all going to be participating in the presentation. Mimi Wallace, who you will hear from, she leads the Wallace Group at UBS, which is kind of the team sponsoring this presentation. And her team manages over $1 billion in assets. That was the goal that our team hit last year. She started in the business in 1979. That is when the Wallace Group formed, and she's really been doing different formats of sustainable investing ever since then. And she's a Nashville native. If any of you are familiar with the company J.C. Bradford, that was a very well-known, long-time Nashville financial firm. And Mimi, I think she was at the age of 33, it was in her early 30s, was named as the first female financial advisor to be named partner at J.C. Bradford. And I think at the time I saw an article, I believe there was only over 100 male partners at the time, and then Mimi was the first woman. So very exciting, and she's been a trailblazer ever since. Laura Kane is going to be doing the bulk of the presentation. We are really excited and fortunate to have her join us because she is one of our top resources at UBS as a whole firm on the topic of sustainable investing. And she's been on CNBC, Bloomberg, in Barron's talking about this topic. So we're excited for you all to be able to hear from her directly and then have her be able to answer questions at the end of the presentation as well. And then just quickly on me, I'm a Nashville native as well. I spent some time on Wall Street in New York, spent some time in Atlanta working with large pension plans and endowments. I actually interned with the Wallace Group, Mimi's team, back in 2003. And Mimi's been a long time mentor and role model, and I joined her team in 2020. And I lead our team's financial planning efforts for the most part. And I'm really excited about how sustainable investing can fit into somebody's overall financial goals. So we'll kind of touch on a lot of these. We're probably not going to get to all questions on sustainable investing, but the goal of this is for it to really be an overview, regardless of what your knowledge coming into this is on sustainable investing. Hopefully you will have some takeaways and some things that you want to learn more about. A few housekeeping items. Kristen touched on a few of these, but we're going to leave questions for the end. We are planning to wrap up our presentation a little after 12 and have some time for questions then. As Diane mentioned, we're going to have a quick giveaway with 3 questions at the end, and then planning to wrap up the whole presentation by 12:30. So just wanted to let you know at which point you can plan to continue on about your day. And one other thing is that because of some UBS internal compliance things, Mimi, Laura, and I cannot see the chat. So we will be asking some questions and things in the chat for audience participation, and Kristen has graciously volunteered to monitor that for us. And she's going to monitor any questions that come up throughout the presentation, and then she'll kind of monitor all that and then ask the questions at the end. So let's see, I will share my screen here. Okay. Let's see. Here we go. All right, can everybody see that okay?
Looks great.
Yes.
Great. Okay. To start us off, I'd like to begin with just a few audience participation questions, and you can either share your answers in the chat or you can just write them down on a piece of paper. And the goal of this is not necessarily to get them right, but to have you all kind of assess these questions and then look back at them at the end and think if your answers or thoughts have maybe changed over the course of the presentation. So we'll ask 3. One is true or false. Sustainable investing is focused on climate change and improving our environment. So again, if you want to throw your answers in the chat, you can write it down or you can just think about it in your head. And I wish I could see your answers, but I'm sure they are good and interesting. Okay, question 2. What is an example of a sustainable company? So, you know, in your opinion, what's a company that comes to mind that you would classify as sustainable? And this is an interesting one because as we'll talk about, there's a lot of different criteria for what can qualify as sustainable. So you can think about your answer at the end and think if it would be the same or different. And then question 3, true or false, sustainable investing involves giving up a little bit of financial performance in order to sleep better at night or feel good about your investments. All right, great, thank you. So again, kind of keep those in mind at the throughout the presentation, and then we're certainly happy to take questions on any of those topics at the end. Okay, here we go. So sustainable investing, why and the what. So we'll start with the why. You know, why is it beneficial to learn about sustainable investing? And, you know, regardless of your personal preference to support different causes, you know, there's a lot of just general trends about sustainable investing that are important to be aware of. It's one of the fastest growing areas within financial services today, and it's very quickly becoming a mainstream approach to investments. Here's on the screen is some stats on growth, or just where we are today with sustainable investing. And not all these are on the screen, but in the US, in the last decade, we've seen assets in sustainable strategies grow by 4 times. And today, as you can see on the left, in the US, roughly 1 in 3 assets that are professionally managed incorporate sustainable investing approaches. I thought that was pretty interesting. And if you look on the right, it's even a little bit greater at about 40% of total assets incorporate sustainable approaches. And a lot of that is driven by Europe and then some growing demand from Asia as well. You know, when we think about kind of why that is, you know, so as I mentioned earlier, we've seen a shift kind of in societal values and just a lot more consumer consciousness. So, you know, people want to know what's in their food and where it came from. And we also want to know, you know, what's under the hood in those investment portfolios. There's also been a lot of investor scrutiny on corporate behavior. So, we want to know what these companies are doing, how they're impacting the world around them, how they're impacting the employees, and then companies are taking note, whether that's because that's their moral values, or also because that's what shareholders are demanding. We're seeing that in general influence sustainable investing and how companies are approaching it. And then we're obviously seeing a lot more political momentum in that direction over the last year or so. And so that's leading to just more all things sustainability. All right, one more slide, and then I will turn it over to Laura. Here is just a general definition of what is sustainable investing. So sustainable investing is an approach that incorporates what's called ESG, which you might have heard of, and we'll talk a little bit more about that. But that stands for environmental, social, and governance consideration, and incorporating those into investment decisions. And it's not necessarily about giving up returns. A big part of it is that these types of investments aim to achieve competitive financial returns. So from here, I will turn it over to Laura, and she will kind of go more in depth.
All right, great. Thanks, Ellen. And thank you again so much to all of you for joining us today to talk about this very important topic in the financial world today. As Ellen mentioned, we're just seeing tremendous growth and interest in sustainable investment strategies, and we don't expect this to die down anytime soon. And just to expand a little bit on what Ellen was saying around the policy environment, we're just seeing so much momentum there. Whether it's the passage of the infrastructure bill, which has some funds dedicated to improving the climate resilience of our infrastructure, or the COP22 conference that's going on right now, and some of the kind of stepped up measures that we're seeing coming out of that in terms of cutting down carbon emissions for the future. All of this is very supportive for this movement towards sustainability, in the broader context when we think about the planet and our economy, but also this movement toward interest in sustainable investing. Now, what's interesting though is that at the same time, the definition of sustainable investing has really been evolving and changing. And we've seen a lot of innovation in terms of products and solutions. And this is great because there's more options out there to cater to different financial and personal goals. But at the same time, as we all know, a lot of choice can also be overwhelming. I liken it to when you sit down at the diner for breakfast and you open up that 12-page menu, and sometimes it's just so overwhelming you can't decide what you want. So what we hope to do today is really to explain better what are the different options that fall under this heading of sustainable investing, and help you to start to understand which types of strategies will suit your unique motivations and your unique personal financial goals when you think about what this can really mean for you in the future. Okay, so without further ado, let's dig in a little bit more and really start to understand what is sustainable investing and what do we mean by E, S, and G. So let's dig into the E, S, and G a little bit and a little bit more detail. So as Ellen said, this acronym stands for environmental, social, and governance. And the key thing here is that you want to focus on E, S, and G information that's material to investment decisions. So it's not about trying to understand every possible thing about an investment you're going to make. It's really honing in on what can tell you more about the risk associated with a particular investment, and also maybe can tell you more about what the opportunity is at hand. So let's go through some examples. So on the environmental side, what's included here, things like how companies manage pollution and waste, what steps they're taking to reduce their carbon emissions. That would all fall under environmental. In terms of what it means for investors, it can help you avoid investing in companies that may have big environmental blowups in the future, whether that's something like an oil spill or kind of being the worst of the bunch in terms of carbon emissions when compared to their peers. And then it can also help you benefit or find opportunities. Right now, we're seeing a lot of interest in clean energy companies. If you look back over the past year and a half or so, a lot of these companies have been quite strong performers. So it's about both risk and opportunity on the environmental side. Then turning to social. So social sometimes is a little harder to understand or less readily grasped. So social really looks at how companies interact with society at large and the people around them. So this includes criteria like workplace safety. So looking at accident rates in factories would be an example. Looking at policies that help to address diversity and inclusion. Also, something like safe and sustainable supply chains would also be included under this social category. And in terms of what to avoid, how you can benefit, for example, what you can avoid are companies that are struggling with conflicts with local communities, or that could see customer boycotts, or avoid companies that perhaps are using, let's say, child labor, and they're going to come under, backlash from consumers. Those would all be examples of things you can avoid by paying attention to social criteria. And then in terms of how you could benefit, so think about something like better workplace productivity. So if you have policies in place that help to, foster diversity and inclusion, all of these things make for, happier workers, more productive workers, and that can ultimately lead to better performance for the company. And then in terms of governance, so governance covers things like looking at the board structure, board diversity, executive comp is another big issue in terms of governance. And again, here in terms of, risks and opportunities, it's about, avoiding companies that are going to, come under, let's say, regulatory scrutiny and face legal fines. And then in terms of benefiting, overall, we find that companies with stronger governance tend to be companies that, have, more sustainable long-term business models. If you think about the example of executive comp, when executive comp structure is right, those leaders are motivated to think about the long-term performance of the company, not just the next quarter. So those are just some examples of what ESG criteria entails and how it can help you make more informed investment decisions. Now, just to kind of further wrap this up, to kind of put it to a real world example, if you think about, let's say, investing in a local hot dog stand, right? What would you want to know as an investor? So yes, you might want to know about sales, profit margins, things like that, things that would be in financial statements, right? But you might also want to know, well, who exactly is running the hot dog stand? Has anyone gotten sick from the food from that particular hot dog stand? Are there any complaints from the local community about odors or waste disposal and things like that? So all of that is what we would consider that ESG type of information that's very relevant to your investment, but not necessarily what you typically think of when you think of financial information. And then on the opportunity side, you may also want to know, is the hot dog stand owner investing in, let's say, meatless options that are less carbon intensive? And maybe because of that, this hot dog stand is going to beat out all the other hot dog stands in the city, right? So this is the type of information that we're talking about. And I think just kind of putting a real world example to it just makes it easier to grasp, because with all the acronyms, it can get, easy to get lost in this alphabet soup, but it's really just using more information in the investment process to make better decisions over the long term. Okay, let's go to the next slide. I think, Alan, do you have the authority to move them forward? Or
I am.
Okay,
Pushing
you got it.
the next button.
Okay.
Let's see.
All right, I'll keep talking
Again.
in the meantime.
Yeah, oh, there we go. I just need to scroll, I guess.
Okay, so now that we have some basic definitions, let's kind of talk about putting it into practice. And I think a good way to talk about how sustainable investing is actually implemented today is to start with some context about the past and what sustainable investing has looked like throughout the past few decades. So sustainable investing dates all the way back to the early 20th century, when religious institutions sought to avoid investing in what are called the sin industries. So things like alcohol and weapons. And then from there in the 60s and 70s, we saw other types of exclusions added, like fossil fuels and tobacco. And this is where that term socially responsible investing comes from. So you may have heard that term before. There's also an acronym for that, SRI. So the distinction here is that originally sustainable investing was exclusively motivated by ethics and values. So that's where this socially responsible word comes from, or terminology comes from. We've gone further than that today. So that's why we prefer to use the term sustainable investing at UBS, because we think it's broader and it captures approaches that really aren't so much about ethics and values, but really about making more informed investment decisions. Now, fast forward to today, like I was saying, sustainable investing is much more than exclusions motivated by ethics. In the early 90s, we saw the first ESG integration strategies. And these types of strategies are like that hot dog stand analogy that I just talked about. It's that more holistic analysis of the sustainability of companies' operations. And then we saw that these strategies were kind of further reinforced by some of the major corporate blowups that we saw during that time period, like the fall of Enron and WorldCom. And then later on, when we got into the 2000s, the demise of certain banks in the wake of the financial crisis. So this is kind of where those ESG integration strategies started to gain more momentum. And then in the early 2000s, we saw the start of what are called impact strategies that allow investors to have a direct impact on social and environmental causes, while at the same time generating a competitive financial return. So we're going to get into this in a moment, but those are kind of the three major types of sustainable investing. It's exclusions, ESG integration, and impact. So we've had this evolution over time. And given this evolution, that's why we're seeing the growth that we're seeing today, because there's broader appeal. So even investors who just want to maximize their risk and return by pursuing sustainable investment strategies, that's a possibility now. So that's why we're seeing the growth in the assets over the past, I would say, 5 to 10 years, we've seen a big pickup. And we've had an interesting survey that we did at UBS that I wanted to share some of the results from. So we do periodically survey a population of global investors that have $1 million or more in assets. And in our recent survey, we found that 60% of those surveyed responded that sustainable investing is very important to them. And 54% said that they're looking to increase their exposure to sustainable investments. Now, importantly, the top reason for doing so the top reason for adding to sustainable investments was actually to boost diversification. The second motivation was values alignment. So that's still a part of it. And then the third was the potential for better returns. So I think that really speaks to this point I was making, that we've gone beyond just values alignment, and we're really reaching more and more types of investors with these strategies today. Okay, so let's get into the three key approaches that I mentioned. So exclusions, I think this is pretty straightforward. Typically, the motivation that we're seeing is to kind of sleep better at night and make sure that your portfolio is not out of sync with your personal values. So even though sustainable investing has kind of more possibilities beyond this today, this is still a valid part of sustainable investing. If that's what you're really trying to achieve with your portfolio, just to make sure that's not out of sync with what you believe in, there are strategies that can help you do that. We've talked about some of the common exclusions, whether it's weapons, alcohol, fossil fuels. Those are some of the more common ones that we see. Some of the more, I would say, nuanced ones. Animal rights is another example. I've worked with clients to kind of sync up their portfolio with their views there. And the thing to keep in mind with exclusions is, it's important to think about how deeply you want to incorporate these exclusions into your portfolio. So using alcohol as an example, let's say that's something that's out of sync with your beliefs. Do you just want to avoid manufacturers of alcoholic beverages, or would you also exclude, let's say, restaurants and airlines from your portfolio that serve alcohol? So it's important to think through that. And in doing so, think about the implications for your portfolio, because if you exclude too many things, then you are starting to limit your investment universe. The second major strategy, ESG integration, we've touched on already with the hot dog stand analogy. So I just wanted to take a few minutes to expand on it a little bit further. So a key thing to keep in mind with ESG integration is the materiality of the information. And the materiality could differ depending what sector you're looking at. So for example, if you're looking at investing in a transportation company, you may want to hone in on those environmental factors like efforts to mitigate emissions. But if you're looking at a tech company, it may be more important to focus on a social factor like employee turnover, because tech companies are very much, their success is very much driven by the talent that they can bring in and retain. So it's important to keep in mind that it's not about considering all ESG information. It's really honing in on the information that can make for better investment decisions. And in terms of, where does this information come from, right? Because we're all familiar with financial statements, but is there an ESG statement somewhere that we could look at? How do we actually find out this information about companies? Well, today it's not standardized in terms of how companies report this information, but it is available in various statements from companies, various public documents. Sometimes it could be investor presentations, it could be an annual sustainability report. But given that it's kind of in different places for different companies in a different format, there are a number of third-party companies that actually have analysts that kind of cull through all this information and come up with scoring for companies. So that's where these ESG scores come from, and that allows research analysts, portfolio managers to actually compare the ESG profile of, let's say, two different companies in the same industry. And then some portfolio managers do their own proprietary scoring. So I can tell you at UBS, we do subscribe to some third-party providers. And then some of our portfolio managers have also developed their own proprietary scoring as well. So it's kind of a mosaic approach to make sure that we're really capturing the information that we need to in terms of assessing the sustainability of companies. And then the last step or piece of this is also understanding how a particular portfolio manager or a particular strategy uses the ESG scores. So you can have strategies that focus on what are called ESG leaders, meaning that the portfolio manager is prioritizing or investing in the companies that have the highest ESG scores. Or there's also strategies that are called ESG improvers, in which case a portfolio manager might be focusing on, I wouldn't say the bottom of the barrel in terms of scores, but kind of middle range that have evidence of improvement, right? That have tangible plans of improving their ESG profile. Those strategies have actually shown quite strong performance as investors are paying more and more attention and placing more importance on ESG issues. So if you're looking at a particular ESG strategy, and this is where a financial advisor could be really helpful in trying to assess all of this, but really understanding where is the ESG information coming from? Where are the scores? What are they being based on? And then how is the information actually being used in the investment process? Those are the questions that you want to be asking, right, at a minimum. So that's ESG integration. And then the last type of strategy, this is kind of the most extreme form of sustainable investing, where you have this desire to have what we call a double bottom line in terms of really making an impact on a specific social or environmental cause, while at the same time generating a competitive financial return. This is very difficult to do with public investments, like investing in stocks, for example. A lot of the times we see these opportunities more in the private markets. I'll give you an example of a really unique opportunity that we had at UBS. We have the UBS Oncology Impact Fund. And this fund invests in early stage cancer research, and a portion of the performance fee and 1% of royalties on treatments are donated to cancer research and used to fund cancer care access in the emerging markets. So that's a perfect example of where you can see it's a specific social issue that's being targeted. There's a direct line from the dollar that you invest to an impact on improving this particular issue. And then at the same time, you're earning a competitive financial return. So impact is more, I guess I would say, more specific in the definition. We really have to see a direct line from the dollar invested to the outcome achieved. And this is a place to kind of look out for greenwashing. We see a lot of like strategies. This term impact is kind of a sexy term these days. And there are, let's say, some passive ETF strategies that maybe they're really just looking at ESG leaders, but they might be called an impact investment. So that's something to be wary of, and where you can kind of put to use what you learned in this class to kind of decipher, is this strategy really achieving what I'm looking for personally for my portfolio? Okay, so those are the three key strategies. Let's talk about the impact that they really have. So, two of the biggest questions that we get around sustainable investing are, what's the impact to the world and what's the impact to my portfolio? And I would say that these three key strategies differ in terms of their impact. So when you're looking at, let's say, ESG integration and exclusions, it's more of a signaling effect. And investing in this way may influence corporate behavior over the long term, and especially when you think about the demand for greater transparency. And as companies have to report more of this information, they're going to be more conscious about what their ESG profile looks like. So I think there's definitely some influence. And then you could also start to see some industries have a more difficult time getting funding. Recently, we've seen some banks say that they won't lend to coal companies, as an example. So I would say there's an impact from ESG integration and exclusions, but it's not as direct as a impact investment. Sorry, I don't have another word I can use, but you get what I mean. And then, like I said, impact investing, much more targeted. There is one, in terms of getting impact in the public market space and public equities, there is one term to be aware of, which is engagement. Engagement strategies are when, as a asset owner, so as an asset manager, you are influencing the companies that you invest in to change their ways in some manner. So it could be, through your proxy voting. You're not going to, let's say, vote to keep a certain board in place unless they're taking steps to improve the diversity of the board, something like that. So there is. That's the one exception I would say when it comes to having impact through public market investments are engagement strategies. Again, we don't have a ton of time to get into it, but just know that engagement is another term that is out there and is actually increasing in popularity. We're seeing more engagement strategies come to market. Okay, so let's dig into performance quickly. So listen, the bottom line on performance is that what we see is that sustainable investment strategies tend to perform, in line to better over time. And the way I would kind of think about this is that it's what we talked about. Sustainable investing, we're taking into account more information in the investment process. We're aligning our portfolios with these sustainability trends that are unfolding with increasing momentum. So, when we look at this, I would say, yes, it all depends on the example like I gave about if you exclude too many things from the portfolio, yes, you could underperform. Or, it comes down to sometimes a particular portfolio manager. How are they scoring companies? How are they using those scores? So it's hard to give a blanket answer. But, looking at, let's say, at the index level, we do see evidence that it's kind of same or better. And we've looked at a number of academic studies on this, and that seems to be the prevailing narrative. I also included green bonds there on the slide. Sustainable investing isn't all about equities. Green bonds are where the proceeds of the bond issue are supporting some kind of social or environmental project. And again, similar return profile, but we actually do see less volatility with green bonds just because of the industries that they tend to be more prevalent in terms of issuance. So utilities, for example, so some of the more defensive sectors. So they offer a little less risk when it comes to kind of the overall risk return picture. Okay, so that's performance. The last thing I wanted to touch on is thematic investing. So thematic investing is actually the area that I specialize in, and thematic investing is separate from sustainable investing, but they overlap. So with thematic investing, our goal is to understand how the world is changing over the next decade and where we see long-term growth opportunities. And perhaps it's no surprise, given what we've talked about today, that about 3/4 of the 25 themes that we publish on for my research team are in some ways tied to sustainability. So themes like addressing water scarcity, sustainable food, renewable energy. These are all considered sustainable themes. So that's where that overlap comes into play. And then just to draw a distinction, we do have themes that are not sustainable. E-commerce would be an example, right? So there are two things that come together and overlap. And one example I would bring up is, let's say a company like Tesla, right? Is that a sustainable company? Maybe some of you wrote that down as part of the pop quiz in the beginning. Tesla is sustainable from that thematic lens in terms of what the company does. Their goods and services are sustainable. They're making electric vehicles, less emissions. But if you look at if you're taking an ESG integration approach, there are some red flags with Tesla, right? In terms of governance, product safety, and things like that. So worker safety is another issue that comes up for Tesla. So there is a distinction between thematic sustainable approaches and ESG integration. And sometimes those two things are combined in the same strategy, just to add even more confusion. But if you came into this thinking, sustainable investing is about investing in solar companies and clean energy companies and EV companies, that's really more of a thematic approach than it doesn't neatly fit into some of the other strategies that we mentioned earlier. Going on to the next page, I just wanted to briefly highlight, if you are interested in this more thematic lens, we wrote a paper earlier this year called The Future of Earth. So as you can imagine, we covered pretty much all of our sustainable thematic opportunities that are tied to the environment in that paper. And I think Ellen did include this as part of the extra reading materials for our session today. So I won't spend too much time here, but just at a high level, we're seeing a number of different challenges face our planet, from air pollution to water scarcity to biodiversity loss. And there's a number of different investment opportunities that we see tied to this, whether it's investing in green technologies like renewable energy, or improving building efficiency, or looking at opportunities in sustainable food and plant-based proteins. There's really a whole host of long-term investment opportunities that we see that are tied to this movement toward making sure that our planet is in good health and that we're moving in a sustainable direction going forward. So definitely check out that paper if you're interested in more of this sustainable, more thematic approach to sustainable investing.
And that is the piece that I sent out yesterday to all the participants. If you just registered within the last 24 hours, you may not have gotten it, but I'll include that again on the follow-up. And that does probably have a lot of themes that I imagine are top of mind for many of you all. And I was going to mention at the end, but I'll go ahead and say we're also going to include more information. We have different pieces because while that piece is great with kind of high-level thematic approaches, there can still be kind of a as Laura mentioned, the menu analogy, just a lot of overwhelmingness. Where do I even begin? So we have a few pieces that can kind of help you with, how do I build a portfolio? Then how do I incorporate some of these ESG factors in there? What are some of these themes that are important to me? And then what are some specific investment opportunities within each of those themes? And Laura, is there anything else you wanted to add before we turn it over to Mimi for a little bit?
I think that's a perfect segue. Yeah.
Thank you, Laura. Always learn so much when I hear you speak, and you always have something new and interesting to present. And for my part, I've been investing in socially responsible investment since 1979. I managed a retirement plan for a rafting company in North Carolina, and I was a big kayaker, and so everybody there was pretty much interested in the water and the environment and so forth. And at the time, as Ellen, I think, referenced, there were fewer choices like Calvert, Parnassus, and maybe Domini were maybe 3 players in the market at that time. And the funds were quite small, so they weren't competitive in terms of being able to manage their fees. So people actually were giving up return at that time. in order to invest along their values. So now, as the slides pointed out, I mean, there's tremendous demand. These are very competitive investments, and that's kind of gratifying to me that it's really come on in this way. And I think women and younger investors are partially responsible for that, because I think women care about kids and, you know, environments and things. Not that men don't, but that I think there's a bit of a driver there in that space. And then people inheriting money, younger people that are more environmentally aware, I think too seems to be a trend that I've observed just in our business. And so I think most of what we see on our team is sort of along the lines of values and stewardship and things like that, where people, let's say they inherit some money, they're often very interested in, like, I want to do sustainable investing. I mean, that's something that's, you know, if they haven't been in charge of the money, and that's where we come into the picture a lot of times on our team. And the good thing about it is that now there's so many options with mutual funds, exchange traded funds, that, you know, small amounts of money can be invested in sustainable or ESG type portfolios, up to large amounts where you would be in what we call a separately managed account, which might require $100,000 to $250,000 in their individual stocks in that portfolio, as opposed to and you would own the individual stocks, as opposed to in a mutual fund or exchange traded fund where you own a percentage of a group of stocks. So sometimes people want more transparency in that way. And as Laura mentioned, on the private equity side, there's some of the funds that people have been interested in, are the women-run businesses. So there's a whole private equity investment of companies run by women. And so that's, you know, having started in this business when there are hardly any women, that's kind of a great thing to have, see that, where people are noticing that too. And that kind of gets more into your social piece, but, and the diversity on boards, and people care about that a lot. More diversity, you know, women, people of color, you know, just a lot, you know, the gender identity, there's a lot more interest in that. So that's been kind of interesting to observe that. So I guess from our standpoint, what we try to do through the financial planning and so forth is help people figure out how much do they want to invest towards sustainable, and you know, how much bonds, stocks. And the great news, like Laura pointed out, is now they're green bonds. And those are kind of a newer thing. So yeah, but I think, you know, and a lot of times, you know, advisors may not know if you're interested in sustainable and things like that. So to let them know would be good, because, you know, it could be, you know, they might be afraid to bring it up, you know, but be good if you have an interest to let people know. And of course you can do it on your own. I mean, you can go online and look up things and invest it yourself. But anyway, what we try to do as from the advisor standpoint is sort of fit the amount of dollars, the portfolios with the client. So that's kind of our role there from our team. So I'll turn it back over to Laura and Ellen.
Thank you. I'll probably add just one more thing on top of that, and then we can happy to take some questions. I'd love to hear what you all are thinking, but a little more along the lines, you know, is okay, kind of what now, or, you know, what are we see clients doing, because this can be a little overwhelming. And we do have some clients who say, you know what, I want to do the ESG integration strategy that Laura talked about, kind of put that ESG filter on my whole portfolio. But often we'll see, you know, maybe I'll start with one account. Maybe I'll take my Roth IRA and I'll try to invest that sustainably and see how that works. Or maybe I'll just take one fund, you know, I'll take the thematic approach. And, you know, I know there's an ETF out there for that incorporates women in leadership roles on boards or executive positions. And there's an ETF that, you know, only focuses on companies with that. You could start with just adding that one fund. there's some clean energy funds out there. You could start with one of those if that's something you're passionate about. So you don't have to start big. You can start small, try it out, compare the performance, see what your options are. And there are a lot more online strategies, companies that will run ESG type portfolios for you. If you have a financial advisor, you could also talk to them, like Mimi said, and just ask the question, hey, do you have those options that I could consider? What do you recommend in that area? So I just wanted to add that. And we have one more slide, which we can come back to if there's no questions, just kind of some myths versus reality. And part of that can be kind of checking the questions that we talked about at the beginning. But before we get to our giveaway, if you want to stick around, we do have 3 giveaway questions. But we would love to hear from you all. And probably the best way to start, at least, is to put your questions in the chat. You may have been doing that throughout. And then Kristen, you can tell us some questions that are rising to the top.
Yes. Okay. So we have a first question from Jennifer. Has COVID changed the landscape of sustainable investing?
Laura,
Yeah, so
I'll let
I
you
can,
take that one.
yeah, I'll kick off, and then if me or Ellen, you have anything to add, go ahead. I would say, if anything, interest actually increased during the pandemic. So I would say that before COVID and the related market downturn, there was some skepticism in the industry to say, well, it's great to see that we are seeing more interest in sustainable investing, but as soon as we get a bad market crash, no one's going to care about the environment or anything else. They're just going to be worried about their portfolio, and sustainable investing is not, going to continue to have this growth any longer. So that was kind of the skeptics' pushback that we would see in the industry. And in fact, during COVID and during the market downturn, we saw the exact opposite. If anything, we saw that sustainable investing strategies actually held up really well. And at the same time, we saw record flows into sustainable funds during the year of 2020. So, I mean, it's actually kind of played out the exact opposite of what the skeptics were fearing. Instead, we saw a tremendous increase in interest. I think it goes back to some of the points that Ellen was making at the beginning too. Coming out of the pandemic, a number of the social movements that we saw, all of this kind of came together, right? We were, a nation, or actually a globe that was, in crisis mode. And I think coming out of that, there's a real desire to make sure that we are rebuilding in a way that's going to make us more resilient for the next crisis, whether that be health related or environmental related. So I think we're actually seeing more interest, and I think people are being more thoughtful than ever in terms of their portfolio and what they're supporting with their portfolio. So I would say, yes, I think we have seen a change, but it's a change for the better. The one area I would say that, and this isn't really related to the pandemic per se, but I would say that, more with having the election going on around the same time, we saw a huge run up in clean energy companies heading into the election at the time. And then, over the past year, we've seen the performance of some of those companies be not as strong. But I think with the infrastructure bill coming through now, we're going to see, this return of interest in investing in clean energy companies, especially if we get more spending later this year with the Build Back Better plan. We are positioning for this, more broadly in the Chief Investment Office where I sit in terms of some of our stock recommendations. This is something that we're anticipating that we're going to see more government spending in this area. So that policy momentum is really strong right now, and it is informing a lot of our viewpoints.
All right, if anybody has any additional questions, we don't have any further in the chat, but feel free to raise your hand. But if not, I will turn it over to Ellen.
Yeah, does anybody want to unmute yourself and ask a question? I'll give one more opportunity for that. All right, and we are available for follow-up questions as well. If you think about something later and you say, you know what, I'd love some clarity on this, or hey, I've been thinking about this, what do you think? You'll have our email addresses. I'm the one who sent out the email yesterday, and as I mentioned, we'll send some follow-up email. So feel free to respond to that with your questions, or we could set up a quick call and see how we could help. All right, time for the giveaways. So we're going to ask 3 questions. what we're going to have in each giveaway is, let's see. So we have some UBS cups, big plastic cups. They are, reusable. So it's actually what I drink out of every day at the office. They're great, portable, got a lid. We have 2 great TWIG t-shirts. Diane, do you want to show us the TWIG t-shirts again?
In just 1 minute, I'll
All right.
unmute in a minute.
And then a couple other things. We have 2 books that we're going to include. One is The Nature of Oaks. I've read this book this year and just loved it. My thought initially was, well, how can you write a book this thick only about oak trees? But I'm telling you, he's a really good writer. And I believe this may be a pick for an upcoming TWIG book club. One more book that includes some environmental topics is Margaret Wrinkle, Nashville local. Her book, Late Migrations, which is a collection of her New York Times articles, and every other chapter is about some observations in her backyard and just environmentalist thoughts that she has. And then this UBS phone charger that you can, super slick, you can carry it with you and recharge your phone. So, okay, now to the questions. Question number, yes, Diane, you got a
Excuse me a
t-shirt?
sec. Here's the t-shirt. There's the t-shirt.
All right.
Big
now that's-
logo. Okay,
all
thank
right.
you.
And maybe we can, maybe I'll stop the share so you can see everybody a little bit better. Okay. Question 1. This will be for a UBS cup and a TWIG t-shirt. Easy one, we'll start easy. True or false? And put your answer in the chat. Kristen's going to monitor it. The first person to put their answer in wins. So true or false? Sustainable investing is only for investors who wish to use their wealth to advance social and environmental causes. Kristen, let me know when you have a winner. I can repeat the question.
Oh, we have a winner. Geneva, you answered the answer false.
All right. Great. Well, and we will be in touch after, maybe Diane, to just get the best drop-off location. We're happy to mail these out as well. Okay. Question 2. They're going to get slightly a little more challenging as we progress. What percent, so go ahead and put your answer in the chat, and if you're close enough, Kristen's going to be the judge. Person closest wins. What percent of professionally managed dollars in the United States incorporates a sustainable investing approach? I'll repeat the question. What percent of professionally managed dollars in the US incorporates a sustainable approach?
And I've dropped it in the chat as well.
Great.
We got a few that are close. Nan and Shaw, you are close.
You can maybe say higher or lower, give some guidance.
Oh, Kendra just got it, 33%.
All right, ding, ding, ding. Great. All right, we will send you, Kendra, The Nature of Oaks and the UBS phone charger.
Yay, I need a new book to read. This is awesome.
All right, it's a good one. Okay, last question. Okay, last question. Again, a little more tricky, so you will see who was paying attention well. Okay, and this one is for Margaret Wrinkle's Late Migrations and a TWIG t-shirt. What are the 3 types of sustainable investing strategies? So kind of the 3 broad types that Laura had talked about, listed out on the page. And it's not ESG, this is the implementation approach of the 3 strategies.
I think some people are busy typing right now.
All right, we'll see. This one's a little tricky and we can give some hints if you need them. You don't have the slides to reference, so it makes it a little trickier. So again, the 3 types of sustainable investing implementation strategies. let me know if you want some, if we need some hints.
I think we might need a few, maybe a hint on the first one to get them going.
Okay, so the first one, I won't say the exact words, I guess is what we're kind of looking for, but if you want to avoid certain companies because of their mission or strategies or practices, that would be one example. An example two.
Ellen's on to something. Ellen, you're 1 out of 3 right now with exclusion. And we have a winner.
All
We have a
right.
winner, Jacqueline. Exclusion,
right.
integration, and impact investing.
All right. Very nice.
Second time's a charm.
Congratulations.
I was way off the first response. Thanks for that hint.
Yes, thank you, Jacqueline. All right. And I think Diane, one of us will circle back
Yeah.
with you all to get these goodies.
And
for
kudos to
you.
TDEC's brain power there, or former TDEC. Anyway, that's pretty impressive.
Awesome. Well, I'll wrap it up real quick. So thank you so much to Ellen, Laura, and Mimi for taking the time to be here today. I know I learned a ton. I didn't even know there was a difference between thematic and impact and sustainable investing. So that was something that was very mind-blowing for me. So we're thankful to the Wallace Group at UBS for being here today, and for my TWIG team in the audience. Excellent job organizing, Diane and Catherine. So for anyone who would like the recording of this webinar, we will be actually sending a follow-up email with the link to that recording. And then for anybody that has additional questions, we'll be hanging on a few more minutes. So feel free to come off mute and ask them. And thank you so much. And I hope you have a great rest of your day.
Yeah, thanks everybody.
Yeah, thank you. We enjoyed it.
And don't forget about the mixer on tomorrow, Thursday, 5:30 at Miel.
There you go.
Yes.
That was
see
really
us there.
great. Y'all did a great job, Ellen, Mimi, and Laura. Thank you so much.
Oh,
Thank you.
Thank you.
Yeah, thank y'all for having us. And Kristen, you can
Thank
probably
you.
stop the recording, or you can